let's get right into it. First slide, where do we stand in terms of GDP growth? Our GDP outlook has basically been about the same for the last year and a half now. We're expecting slowing growth as we move forward. I will explain some of the reasons why growth will slow. A lot of it, of course, is higher interest rates and the fact that consumer savings is slowing, which suggests that consumer spending will slow in the future. But the big thing I think right now, and we saw the stock market react to this, is there's a growing chorus of people who think we're in a recession. I think that view is too negative. I think we're going to be moving into something that looks a lot like a soft landing as the Fed begins to ease on monetary policy. But for the last year or so, when we've given that forecast, as we have on the subheading of this slide, you can see soft landing for the cycle, question mark. Now, what is that question mark? It's not looking forward. Looking forward, we don't have any negative quarters in the forecast. They're slower. They're in the 1% range, but they're not negative. The question mark really refers to looking back. And my argument goes that, certainly for the housing market and the commercial real estate market, there was a recession in 2022, 2023, and basically up until now as we begin to move into that period of lower interest rates. Moreover, this week, watch the business news data on Wednesday. On Wednesday, we're going to get pretty significant revisions to the jobs data that's been published over the last couple of years. I would be willing to bet right now that the jobs data overestimated the amount of jobs growth. And so what that would suggest is backward looking, it may be the case that 2022 and 2023 was a soft recession, and the academics who score these things never officially called it a recession. So there could be kind of a backward looking and almost a retrospective call that, yeah, we did experience a recession when the Federal Reserve began to raise interest rates. But going forward, if interest rates move lower, we do expect growth to remain positive, but overall slow. And the common question I get is, well, okay, give me some examples of strength in the economy. Well, there's a pretty obvious one right now, which is the construction of manufacturing facilities for semiconductor chips. And that's what you're looking at here. You can see this takeoff since the fall of 2021. I mean, these are really massive growth rates. This is something, by the way, the Trump administration and the Biden administration both wanted to accomplish, albeit with very different tools, policy tools. But nonetheless, we're seeing it happen. And why is that? Well, the AI revolution is going to require more of these computer chips, and more than half of them right now are made in Taiwan, which is one of the more geopolitically dangerous places on Earth. So this is likely the beginning of reshoring or inshoring manufacturing activity. I think it's going to be good for the economy. And depending on the election results, we could see more of it occur. But this has been a place of strength for an economy that certainly has sagged over the last 2 years. Another point of strength is a little complicated, but the population in the United States is actually larger than most analysts had expected it to be. So what you're looking on this slide is the change in population growth by year, composed of two different sources. So the red is natural growth. That's the gain in population each year where births exceed deaths. So for example, in 2004, we had about 1.5 million more births than deaths that grew the population. Like you see the red bar there. The blue is population growth from net immigration. In other words, immigration minus people leaving the country. Now, very few people leave the country, so this is mostly immigration. Now, take a look at the pattern of the red and the blue, particularly since COVID, since 2020. Lots of growth for blue, not a lot of growth for red. And what's really happened in the last 3 years is a really dramatic increase in immigration. Now, I know what you're all thinking, is that illegal or legal, documented or non-documented? We don't have the data for that. You can draw your own conclusions from it. But take a look at that blue bar for 2023. There were 3 million people who immigrated into the United States during that time period. The Census Bureau estimated it was 1 million. So I'm not using the census data here. I'm using data from the Congressional Budget Office because they went to the Department of Homeland Security and said, how many people really came into the country? Now, you obviously that's going to be an election issue in terms of border control and immigration status. But from an economic growth status, it means there were more people here spending more money. Now, some of that money is obviously government support, but that spending power has also supported the economy in the short run. It's one of these things, though, that is going to weaken as we move forward. But this is kind of really interesting, the composition shift of population growth, much more dependent on immigration and a lot less natural growth. And the surprise on the data side that a lot more immigrants came into the country than the government estimates initially indicated. Now, we said growth is going to slow. Here's an important reason why. The personal savings rate is weakening. In fact, in June, it was at 3.4%. Compare that to 2019 when it was above 7%. So the savings rate right now is half of what it was in 2019. It's below the kind of the 5 to 6% average we saw from 2013 to 2019 itself. And what does a slowing savings rate mean? It means that future spending coming out of that savings is going to be weaker. So that lower savings rate is a sign in terms of the forecast that consumer spending is going to be slowing. And we're already seeing that in public company reports, McDonald's, Starbucks, about the consumer beginning to slow. And that is all an indication and consistent with the macro forecast that I gave you at the beginning. Slowing is also occurring in the labor market. The unemployment rate is now almost up to just under 5%. We do think it is going to continue to rise in the next few quarters. The unemployment rate, which is in red here, typically it's the last variable that measures weakness in the economy. It shows up last in terms of the data. So the next president is probably going to be unfairly blamed for some of the slowing that's already kind of baked into the cake. But the real, from a monetary policy or an inflation perspective, is the blue line that we want to look at. That's the job openings rate. It's the measure of help wanted signs that are out there in the U.S. economy. You can see where that job openings rate peaked in early 2022, late 2021. There were 12 million open jobs in the U.S. economy. And at that time, there were only 6 million unemployed individuals. So you could have taken every single person that was unemployed, put them into a job, whether they were skilled for it, whether they were going to show up in 4 weeks, and you still would have had millions of open jobs. That's how tight the labor market was coming out of COVID, because millions of workers moved to the sidelines and never came back into the workforce. So the Federal Reserve viewed that as an inflation risk. You got a lot of open jobs, wages are going to grow faster than productivity growth, and that's the definition of inflation. So what did the Fed do? Well, they raised interest rates in early 2022. And once they started raising those interest rates, the cost of capital, the cost of business financing went up, and that blue line went down. So the number of help wanted signs began to come down. In fact, right now, if you look at the subheading on the slide, we've got just about 8.2 million open jobs. It used to be 12 million, so we've effectively lost a third of those help wanted signs. And we did some estimates about a year and a half ago where we felt like once that number got right around 8 million, the Federal Reserve would be in a position to begin to cut interest rates. And that's right where we are. So, if we see this number drop below 8 million, it is a real strong green light signal to the Fed to begin reducing those interest rates as we move forward. A little bit of local data. So if you look at the U.S. as a whole, since COVID, we've got 4% more jobs in the U.S. economy than we did in February of 2020. So if you look at that blue line, it drops down during COVID in 2020. It takes about 2+ years to recover. And right now we've got 4% more jobs, that 104% measure, 4% more jobs in the U.S. economy. Where does Virginia stand? Well, the data is almost identical. I mean, the Virginia data looks a lot like the national data. The fastest growing job growth, by the way, and I think I've got it here on this slide, if you want to look at it state by state, The states in red are actually the slowest. They have remarkably still not quite recovered all the jobs that were lost during COVID, which is kind of an incredible measure. All the states in blue have recovered all the jobs that were lost and have gained some. And then the states that are on the far left hand of the slide, Idaho and Utah in particular, have gained even more jobs than the country as a whole. So rather than 4% job growth, which is what we see for Virginia, what we see for the US, Idaho and Utah are at about 12% job growth during that period, triple the national average. They didn't lock down as much during COVID, and just the mountain state economies are growing faster because of better business policies. I mentioned earlier that we want to see wages growing roughly with productivity growth. The red line here is wage growth. The blue line is productivity growth. You can see in 2021, these two lines separate. That's the definition of inflation. 2021 through up till now, wages have been rising faster than the output of goods and services, the productivity growth of workers. So to an economist at the Federal Reserve, that gap between the red line and the blue line is inflation. And here's the good news. The red line and the blue line are now converging. So again, it's another signal like the job openings data that I showed you earlier that the Fed can be in a position to begin to reduce interest rates. And frankly, those two lines are converging in the best possible way. Productivity growth is going up. I can't tell you why. Frankly, it doesn't make a lot of sense to me right now, but we'll take the data for what it is. But that's a better outcome than the red line collapsing, wages going down, which would, of course, reduce consumer demand for things like housing. So the red line and the blue line coming together is another sign that inflation is ending. And here's the inflation data. Here's where we stand. The blue line is the CPI, the Consumer Price Index, the broadest measure of inflation. It's not technically what the Federal Reserve targets, but it's good enough for what we're doing here today. In June of 2022, it was at a 9% year-over-year growth rate. That was a more than 4-decade high in terms of inflation. And through higher interest rates, and maybe not the policies I would choose, the Federal Reserve is more of a demand-side organization. It raises interest rates to collapse demand. That's one way of bringing inflation. I would argue that working on the supply side is the better way if you want to control prices, produce more goods and services. But nonetheless, the Federal Reserve has used demand-side policies, and inflation has come down. But the challenge was for much of 2023 and the start of 24, it kind of stalled. You can see that blue line kind of leveling off in the 3% range. And the big reason why that is the red line, shelter inflation, housing. The housing deficit, the housing shortfall has kept housing costs rising faster. Right now, housing costs are going up almost twice as fast as overall inflation. And that's not something the Federal Reserve can solve, right? That the only way to tame that last leg of the inflation fight is to build more attainable housing for sale and for rent. And so it is going to come down because there's more apartments coming out of the construction pipeline. But just as a thought experiment, if you were to reduce that red line from 5.1% down to, say, 2.5%, inflation would be overall inflation, the blue line would be at 2%, and it would be mission accomplished, and the Fed could dramatically lower interest rates. So the challenges that we've identified over the last decade of regulatory burdens and permit fees and impact fees and delays and all those kind of things have made it harder for home builders to do their job and supply that attainable housing is keeping that red line highlighted. And the reason I kind of identify that is that NAHB's senior officers go off to meet with Chairman Powell and the governors of the Federal Reserve once each year. We do it in June of each year. In 2023, we warned them that shelter inflation was going to be the most difficult part of the inflation challenge. And I got to say that message went right over their heads. They said they were focused on something called super core inflation. In 2024, just a few months ago, when we met with them again, they actually led this time with, you guys were right. Shelter inflation was a challenge, but we can't do anything about it. So, I mean, we got them, maybe 20 yards down the field. We're still not kind of in scoring position, but our ask to them at that meeting was, we understand you can't address impact fees and all those other kinds of regulatory issues, but you could at least talk about them and recognize that state and local government policy can help in the inflation fight. And we started to see some hints of them doing that. Think tankers and some academics have made that argument in the last couple of months as well. But nonetheless, the blue line, 2.9%. We're getting closer to the Fed's 2% target. And so what do we think the Fed is going to do? Well, that red line is the Fed funds rate. It's been on pause since July of last year at a 5.5% target. And we had moved our forecast around. We started the year thinking we would see 2 to 3 rate cuts this year. Then, when the first quarter inflation data was worse than expected, we reduced that down to 1 rate cut beginning in December. And now the bond market really seems convinced that we're going to see our first rate cut in just a few weeks. The first rate cut's coming in September, and we could see a second rate cut in December. I think both of them will be 25 basis points. There's some talking about 50 or even 75. I don't think that's going to happen. But I think 1 or 2 rate cuts, close to ironically, our original forecast from last Thanksgiving, that we would see 2 or 3 this year, is looking more correct. And our December call is now looking more conservative. So again, just like the headline of the presentation, the good news is those rate cuts are coming. What does that mean for mortgage rates? The red line here is the 30-year fixed rate mortgage. It peaked at around 8% in the fall of 2023. So we're past the peak rate. It did push housing affordability conditions to a more than decade low. And as I said at the beginning, this line is going to move lower. The forecast line looks real smooth, like it's going to be a fairly gradual decline. There's going to be some ups and downs. But here's the good news. By the time we get to the end of 2025, we're looking for a 30-year fixed rate mortgage to average around 5.9, 5.8%. So something below 6. And I think that is good news, because when we look at the consumer data in terms of preferences, there's no magic numbers in markets, but if you get right below 6%, it does seem like a disproportionate amount of demand comes off the sidelines and is looking to buy. So I think that's the direction we're headed by the time we get to 2025. Now, a little bit of a pivot. The last few years, the concern for policy has been the Federal Reserve raising interest rates too much and taking too long to cut them. We're now going to be moving into an environment where the concern is less the Federal Reserve, and the concern is more going to be the government's deficit and debt. So the blue line here is the debt held by the government as a share of GDP. At the red vertical line, which is the last data point that we got for this, we're a little bit above 100% debt to GDP ratio. In other words, the size of the government's debt is exactly equal to 1 year's worth of GDP. That's pretty high. If you look back at the data back in 2006, it was closer to 40%. So it's a dramatic increase over the last decade and a half. Here's the problem. As that blue line continues to rise, is going to put upward pressure on interest rates. So our concerns from a policy perspective and interest rates are going to be moving from the Federal Reserve's actions back to usual government actions of taxes, spending. And in 2025, the 2017 tax cuts are going to expire. Obviously, those tax cuts have had a great benefit for the economy. But as we look to extend them, some of those tax cut extensions are going to have to be paid for, ideally by cuts in government spending. If they don't, and they add to the debt, then we could see higher interest rates. And that's going to create a difficult challenge for our industry. We're going to have to judge the benefits from lower taxes with the cost of more debt, which would push interest rates up. So what do you want? Lower tax rates or slightly higher interest rates because the debt is larger? And that's something that NAHB's government affairs team and my team is doing the research right now, so that we're prepared to identify those trade-offs for the members to decide policy in 2025. All right, so we talked about interest rates. Here's home prices. Again, Virginia's data looks a lot like the U.S., both up more than 40% since COVID. Very different run-up in home prices than what we saw in 2005 and 2006, which was mortgage underwriting being bad. It was a demand side effect. This is a supply side response. It's the housing deficit. We haven't built enough housing for the last decade and pushed home prices up when we saw historic low interest rates right after COVID. And what's remarkable is when interest rates got up to 7 and 8% for mortgages, you can see on this slide, those lines don't go negative. They just change their slope. They kind of shallow out a little bit. That right there is evidence that 7 and 8% market didn't cause prices to collapse. That's proof positive of the ongoing housing deficit. What do we think home prices are going to do? Well, I do think these rates are going to flatten out. They're going to go kind of 0% rates for a little while. We could see some declines. In fact, we're already seeing that a little bit in Florida, some parts in Texas, to allow for incomes to catch up. But what's going to keep home prices from collapsing is effectively lower interest rates, which I said before are now coming in the forecast. And it's not just financial variables that matter. We also look at population growth rates. Here again, the Virginia data looks a lot like the US, up more than 7% over the last decade, about a 0.5% growth rates over the last year. So the Virginia data really is really representative of what the country as a whole is going through. That's good news, by the way. I do these talks, several of them each week. There are a fair amount of markets across the country that actually have negative population growth. Those are people that are leaving those markets and coming to places like Virginia and the Carolinas. And then something we watch all the time. It's more long run issue. I think it's going to get talked about in the presidential campaign. But the fertility rate in the United States has been going down for more than a decade, and it's an issue not just for the population of the country, but it's an issue for home builders in terms of demand, say 10 and 15 years out. My argument would be that for those policymakers who are concerned about us not having enough kids, let's build more entry level homes. It facilitates earlier marriage, and then people will have more children. I really view this as a cause and effect with some of the challenges in the housing market. All right, supply side issues, and then we'll take a look at the forecasts. Top issues facing builders. If you look at the top three, skilled availability or availability of skilled labor, building material pricing, and then the one that I think is going to grow as we move into 2025 is the cost and availability of lots. Home buying demand is going to come back into the market before the lots are able to move through the lot development pipeline. So expect some volatility in terms of lot pricing. And I include some new data that we just finished on looking at the distribution of lots that are actually built on for single family homes. In the media, you see all the time that builders keep building on bigger and bigger lots. That's actually not true. It's something I've been fighting with journalists, it feels like for a couple of years on. If you look at, for example, the purple and it's kind of the black color there at the bottom, back in 1999, it was less than 50% of homes were built on lots less than a fifth of an acre. Today, it's more than two-thirds. There's right around two-thirds of homes that are built on a fifth of an acre lot. So this is data that we push to policymakers to remind them if they get rid of exclusionary zoning rules, builders would build more, because that's what we see in the data is a growing share of homes built on ever smaller lots. It's what the market wants. And townhouse construction, by the way, is a good example of that. Townhouse construction last year was up 6%. When the overall single-family home building market was down 6%. So that frustrated first-time buyer is looking to get into a home. They're not looking for a big lot. They're looking for an energy-efficient home. Building material pricing has been roughly flat for last year. It's rising right now, and it's likely to increase as we move forward with gains for single-family construction. And of course, the thing we really watch for this is lumber prices. Lumber pricing's been kind of soft here for the last 2 years or so. I would expect lumber prices to rise. We're seeing actually this week, incredibly, I can't believe the stupidity of this move, but the lumber tariff on Canadian softwood lumber is rising from 8 to 9% up to, I believe it's going up to 15%. So that's going to put some upward pressure on lumber prices. A period of time where we saw tariff rates go up on lumber was 2018, and you can see what happened to pricing then. It went from the $400 range up to almost $600. So if you're forecasting and you're looking at the market, I think you've got to kind of expect some gains for lumber prices over the next 2 years. Labor, 300,000 construction workers. That red line is how bad the labor shortage is. It's gone some ups and downs here the last couple of years as we saw declines for home building, but my expectation is the skilled labor shortage, after weakening here as the labor market softens, is going to go back and rise again in 25 and 26. So all those efforts that state and local associations are engaged in, the Home Builders Institute, in terms of developing our skilled labor force, I think is going to be important for the next decade. AD&C loan conditions, average rates right now are between 12 and 15%. The good news here is as the Fed cuts, those rates are going to go down one for one. Every time they cut 25 basis points, we'll see AD&C loan rates move down 25 basis points. So, we're expecting these rates to go down 200 to 300 basis points over the next, say, 6 to 8 quarters. And that's going to be good news, particularly for smaller private builders. And then if you've seen me present before, you've seen these estimates before, but just a reminder, those regulatory costs are still in the system, and they represent about a quarter of a typical newly built single-family home purchase price. I won't go through all the data on this slide, but we're seeing a rise in architectural design standards. That's the one in yellow. I keep hearing that as I travel across the country. So there's a lot of different ways that, inefficient costs get built into the system. And as Craig said at the beginning, I do a fair amount of testifying. This is something I mention a lot to policymakers. If you're looking for ways to allow builders to build more of that entry-level type home, more affordable, attainable housing, reduce these costs. There's a large number of them. Pick a couple and reduce them and bend the cost curve in the right direction. And then that kind of gets kind of wrapped together with Jim Tobin, NAHB's new CEO, the new 10-point plan that we've got in terms of our advocacy issues. I won't go through all of them, but you can see a couple of them that were highlighted in the data points that we walked through today. For example, let's say the top three: excessive regulations, promoting careers in skilled trades, and fixing building material supply chain. So these are all issues we got to work on if we want to add additional housing supply, reduce the housing deficit, and of course fight shelter inflation as part of that inflation battle. All right, our forecast, and then happy to take some questions. The remodeling market, a little bit of a soft patch. It was just a couple of quarters, but overall, we think the remodeling market's going to continue to grow. Got an aging housing stock and growth in age-in-place remodeling for older Americans. And then inventory. There's been some really bad media pieces. This is another time of mentioning bad journalism, but some bad media pieces looking at just the new home month supply measure. So we're going to get new home sales red text here above 9 months. Ordinarily we'd say anything above 6 months is a challenge, but the blue, the resale inventory, is at 4, which is quite lean. So when you combine the two, combined month supply right now is 4.7. Anything below 6 is an indication of low inventory. So we're still in a low inventory environment, despite the fact that the new home inventory is above 9 months. And then here's our money slide, the new single-family home construction. We had declines in 22, 2023. We're looking at about a 6% gain in 2024. Smaller growth in 25. This is really more an arithmetic issue. You can look at the blue line. We're actually growing on a quarterly basis through 25. I think by the time we get to 2027, we'll be looking at about 1.2 million single-family homes built a year, and then kind of leveling off, because that 1.2 million level is high enough to reduce the housing deficit by about 100,000 homes a year. We think the housing deficit is 1.5 million homes. So it's going to take about 5 to 10 years to really kind of put a meaningful dent in that housing deficit. Here's the Virginia data in terms of single-family permits. Virginia actually had a really good 2023, a 1% increase Much of the rest of the country was down 6 or 7% last year. And then year to date, thus far for the first half of 2024, Virginia is up 9%, again outperforming the rest of the country. So those strong population growth trends, uh, relative housing affordability, obviously not housing affordable like the Midwest, but certainly better than what we see in California. These are all positives for the Virginia market. And then if you want a sense of where the biggest markets are, here's the top 10 list. A lot of markets in the South. The top two, Houston and Dallas, kind of stand alone. Houston and Dallas combined last year built 90,000 single family homes. The entire state of California built 60,000. So that really shows you how big those two markets are. So more than 50% of single family home building occurs in the South, and those trends will continue. Custom home building. So this is smaller builders building on an owner's lot under a construction contract. It's about 20% of the market right now. I include this slide because this data is often not reported in the business press, but it's an important part of the market. It tends to be larger, more expensive homes, and it's a little bit more stable. It moves a little bit less up and downs with changes in interest rates. So we think that 20% market share is going to be kind of the new normal for custom home building nationwide. New home size been declining for the last decade. That's because housing affordability has gone down. Did go up in 21 and 22. That's the Zoom room, work at home effect. But the overall decline for the last decade is pretty clear on this graph. We do think by the time we move to 2025, this decline will end and new home size will actually begin increasing in 2026 with those lower interest rates that I talked about earlier. And the apartment construction, the long anticipated decline is underway and will continue through the rest of this year. We had a 13% decline in multifamily starts last year. We're looking at more than a 30% drop this year. Tight financing conditions have really kind of restricted the pipeline of apartments. Right now, we're close to 2 apartments completing construction for every 1 that starts construction. So there's just a lot of supply coming online. That's going to slow rent growth down, raise rental vacancy rates. But we think this market will stabilize in 25 and then kind of grow back to trend rates in 2026. So if we put this all together, 2024, Fed's going to ease before the year's end. Interest rates will begin to normalize. Single-family home building is going to be growing even as consumer spending slows. We talked about all the supply side issues. And then for the back half of this decade, it looks like a pretty good runway for home building growth given the demographics, given the housing deficit. And then 2030, we could talk about this in Q&A, but it does look like a more challenging environment. Demographics move against us. We've got some cost factors that are going to progressively get worse, including insurance, which is obviously a challenge right now. I think that's going to be an ongoing policy challenge. The insurance market is really buckling under a variety of different challenges, and it's having really large impacts right now in states like Louisiana, and that's likely to spread through the rest of the country in the coming years. And just to give you a sense of the demographics, again, if you've seen me present, you've probably seen this slide before, but just keep in mind the demographics really are with us right now. The numbers at the bottom of the screen are a set of ages. So, for example, those in their 30s and early 40s, that's the millennials. There's a lot of them compared to my generation, Gen X. And Gen Z is smaller, but there's still a large number of people there. It's Gen Alpha that's going to be the weaker part. We talked about the declining fertility rate. When today's 8 and 9-year-olds become tomorrow's 22-year-olds, there's going to be fewer of them, and it is going to affect rental demand and first-time homebuyer demand. But that's more than a decade off. But it is something to kind of keep in mind in terms of long-term development plans. So with that, I want to thank you very much. As Craig mentioned, I'll make sure that we get a PDF copy of these slides. And Craig, if we got any questions, I'm happy to take any that the attendees have.
Okay, great. Well, thank you, Dr. Dietz. Very informative as always. If you have any questions, go ahead and enter them into the chat. That's probably the easiest way, or raise your hand. We can do one way or the other. So questions? I don't see that we've had any during the program unless I missed them. Other than that,
Craig, I put one in,
Did you
Lewis
put one in?
Pinero. Did you see my question?
I did not, Lewis. So if you can go ahead and ask it, that would be great.
Okay. Rob, do you attribute the rapid rise in inflation to the 9% level in 2022 to Biden's three policies, American Rescue Plan Act, Infrastructure Jobs Act, and Inflation Reduction Act? I think it allowed up to 3.8 trillion in spending.
Yeah. Yeah, it's not 100% due to inflation, but certainly I think you can make the argument that we stimulated the economy too much coming out of COVID through both fiscal policy and let's not forget the Fed. The Fed was also pushing a lot of monetary policy. But yeah, I agree with the thrust of your argument, which is that government did too much for a situation, COVID, which we can have a debate about, but kind of was overreaction. And so the result is that we had about $9 trillion of cash and financing floating around the economy. And what did it do? It pushed up just about every price, wages, grocery prices, energy prices, housing costs by 20 to 30%. Yeah, I think what economists will do looking back is say, the government overreacted. And then I think most economists, even the ones on the left, would probably say that last round of stimulus, so the Inflation Reduction Act, was too much. And that's what really kind of generated the problem where the Fed now had to really jack up interest rates. So it's a great question because it's a reminder that as we go into, whoever wins the election this year, as we move into 2025, we're really going to have to, as an industry, be focused on the debt and the deficit. And that was something coming out of the Great Recession that we didn't really do. I mean, I talked to builders, and builders always said, I'm concerned about the government being irresponsible. But we're going to have to watch the numbers because we've got to both defend good tax policy that are going to help businesses, that are going to help promote home ownership, but we can't let that debt and deficit level rise too much, or it will push 30-year mortgage rates back up to 6 and 7%. Yeah, thank you.
All right. Another question here, Dr. Dietz. I think it's specific to your statistics on multifamily, but does that speak to apartments or does that include condos for sale?
Yeah, so the multifamily, I put the slide here. The multifamily is 2+ unit production. So it's duplexes on up, is built for rent and built for sale. What it does not include is townhouse construction. Townhouse construction is part of single family. That's just the way the Census Bureau does it. It's the way we do it. I understand that, a lot of local classifications more based on building codes or energy codes will do it differently. But townhouse construction is about 17, 18% of single family starts right now. I think it'll rise to 20. But this is a combination of both built for sale and built for rent. And within the multifamily component, so duplexes on up, right now it's 95, 96% built for rent. So the condo share is only about 4%. If you go back and you look at the early 2000s, the condo share was 20% on average. And in fact, during the housing boom in 2005, 2006, the condo share was 50%, right? There was a lot of multifamily buildings that started out as built for rent, and they switched over to condo. Litigation rules, some of the headaches around condo development and the like has really just kept that built for rent share elevated. So it's 95%, and I think it's probably going to stay there. So what you're looking at is traditional multifamily built for rent. What we've seen that's a little bit, I wish I had the slide here, but we had been seeing a growing share of large multifamily, and that has reversed in the last year. The growth in multifamily has actually been in exurbs, rural markets, and more 1 to 2 story multifamily, and the share of steel, concrete, high-rise multifamily has been shrinking. And that just has a lot to do with development costs and the impacts of higher interest rates. Smaller apartment developers that can self-finance or can get equity partners have continued to build, and that tends to be in small towns and rural areas.
All right, great. And then the next question is about bank balance sheets and the ability for banks to lend to the residential development industry.
Yeah, so I'll back it up and park it on the A, D, and C slide when we talk about that. Commercial real estate's got some challenges, so that's going to create issues for some of these banks. There's a fair amount of extend and pretend going on. We know that office vacancy rates, for example, right now, I think officially nationwide office vacancy rates are around 20%. But if you measure something that we call phantom vacancy rates, which is, not what the official, how many tenants do you have, but if you walk around a building like you can in Washington right now, and on a Monday, 60% of those offices are going to be empty. The phantom vacancy rate in San Francisco is like 85%. I mean, it's incredible. So that's not generating the same revenue, even though there's an official tenant. So what's that going to mean? Well, it means those banks are going to have to take some hits as they extend, as they wait for lower interest rates to do some refinancing. The good news is we don't view this as a systemic threat. The commercial real estate market is about a quarter of the size of the residential market, so it's not like 2006, 2007. But as I think that question sort of is suggesting, it does have a spillover effect on the A, D, and C loan market because those banks have losses. They're going to be naturally risk averse. They've got the regulators looking at them. And so the result is that they're going to be a little less likely to take normal entrepreneurial risk into land development and land acquisition loans. So that's another reason why I said at the very beginning of this section that third one, the cost and availability of lots, I would expect a lot crunch as we move into, say, late 25 and 26, because I don't think lot development is going to keep pace with the inbound, the pricing in of those home buyers with lower mortgage rates. So it's both the cost side, and it's also some of the spillover effect of some of those bank balance sheet issues that question asked about.
Okay, great. Yes, we'll be sending out the slides to everyone. And are there any other questions? Okay, well, seeing none, Dr. Dietz, just want to thank you again. Really appreciate your time. I know you have this right here, iownhousing.org. Everyone here is a member. It's they've got a ton of information and data that they put up, Robert and his team, and then housingeconomics.com. So they send I don't know, it's a daily blog, weekly blog, as things are happening. They're trying to keep you informed. The more people we have speaking our message, the better.
Amen.
Amen. All right. Very good. And with that, I know you're traveling out to Salt Lake City tomorrow to speak to all of our local associations and the EOs out there. So safe travels to you. And if anybody has any other questions, you know where to reach us. We're here for you. We appreciate everyone being a member, and have a great Monday.